It's time for Yahoo Finance's Market Minute. Stocks are jumping. The S&P 500 breaking above the 6,000 level for the first time since February on the back of that stronger than expected May jobs report. President Trump taking to Truth Social to celebrate the data and call for the Fed to cut rates, saying, quote, go for a full point. Plus, Tesla is rebounding from Thursday's slump as investors hope for a cool down in the feud between Trump and CEO Elon Musk. The online dust-up initially leading to a more than $150 billion wipeout of Tesla's value. And Lululemon shares sinking after the retailer cut its full-year profit guidance, citing higher tariff-related costs as well as increased markdowns. A number of analysts slashing their price targets on the stock while maintaining their ratings, including BMO Capital, Needham, and TD Cowen. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, you can scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. On today's show, the labor market looks resilient, wage growth rising by more than expected in May. We'll hear from an expert about what this really means for job seekers. And we have the CEO of Omada Health, hot off of their $150 million IPO, live from the NASDAQ. Our very own Anjali Kemlani brings us that interview in just a few moments. Plus, we get a read on the consumer with the CEOs of Runway, Tanger Outlets. You don't want to miss that. Huge conversations coming up over the course of today's show. Let's dive right in. First, let's begin as we always do. Let's take a look at some of the market action. We are 90 minutes into the trading day. Major averages higher across the board. Stocks rising to end the week after a stronger than expected May jobs report. Joining me now, we've got Thomas Martin, Globalt Investments, Senior Portfolio Manager. Your strategy right now is to maintain diversification. So walk us through how you're doing that.
Yeah, so we have exposure to really all aspects of the equity markets, both in the United States and abroad. But we're fairly neutral in terms of that exposure with regard to growth and value and large and small. Our biggest overweight really is in the mid-cap stocks and in mid-cap growth. And we are underweight in international companies, but we still have, some decent exposure there. We have a duration neutral in fixed income. And we have some, I guess one place where we're a little bit kind of more diversified or more conservative is to have a little bit of dry powder and cash that we can use going forward. And in the alternative space, we have a fairly large exposure to gold and the gold miners, which has been a good substitute for the equities as it's been about as strong as those markets have been.
And so all that in mind, coming into the start of this week, we were already 98% of the way through the S&P 500 earnings reports. And so as we essentially kind of close off this earnings season, what are the anticipations for how investors should position themselves, knowing that there are going to be some areas where there was no guidance or diminished guidance that they're going to have to kind of measure up against? Does that set us up for any type of relief in the next earnings season?
Well, I think what's interesting about the earnings is that for the first quarter, coming into the quarter, we were looking for about 7% growth, and exiting the quarter with the actual experience, it was about 13% growth. Now, in the meantime, the estimates have been lowered for the second, third, and fourth quarter, and so therefore for the full year. So growth expectations have come down a bit, notwithstanding the strong quarter. And there are a lot of cross currents in the market. Companies are not getting any credit for saying they don't know what's going to happen. And companies that are saying, we have some degree of confidence are getting credit for that. So our approach has always been an earnings-based approach and looking at what happens with their estimates. And so we want to focus on those companies that are able to work their way through it and de-emphasize the companies that are having more struggles.
And so according to data from FactSet, Magnificent Seven companies reported earnings growth above 25% for the first quarter. So for the other 493, what do those opportunities look like, especially as it relates to maintaining their earnings growth or trying to solidify confidence among investors? And where are those opportunities from your perspective?
Yeah, so you still have opportunities in the healthcare area, although the stocks certainly haven't reacted very well. But there's the earnings growth there is expected to be above 10%. And we see opportunities in the communication services sector. So there are a number of companies there that are in the more entertainment type economy, the experiences economy, and we want to be focused on those names. Those companies are reporting pretty well. Consumer names that are also in the experiences area are faring well, and so we want to have some exposure there. Also, in the industrials area, the AI trade, the electrification trade, those are companies that are continuing to see, good prospects, not just now, but for quite a while into the future.
Just lastly, while we have you here, you in your notes to us said that the Fed is in extended skip mode, despite the president tweeting out, or I should say, truthing out. He posted on social that he wants, of course, as he's continued to say in the past, for the Fed to cut rates. The likelihood of that, and walk us through your Fed in extended skip mode.
Yeah, of course, President Trump has always wanted rates to be lower, so that's not really a surprise, and it's kind of counter to what we saw in the data today, which was a stronger economy and a quite resilient labor market. So, the expectations for the Fed actually to cut were increased because the data right before this was more stagflationary potential. And so you got a rising in the expectation for a cut in September and then a second one in December. That's backed off a tiny bit, but not very much. The Fed just continues to say they want to be patient, they want to be measured, they want to be careful. And I think that, looking for a cut in September just to have a cut, doesn't really stack up with that kind of a philosophy. So our view is that there's a pretty high bar for a cut. I mean, certainly they don't want us to go into a recession. And if we get some data that is definitely pointing in that direction, we think the Fed will take action. But we just don't see that happening. Yes, there's a lot of uncertainty with regard to what will happen with the tariffs, but that's exactly it. It's uncertain. We don't know what these negotiations are going to produce. Could have no tariffs, could have 10% tariffs, could have higher than that. And so when we get that information, the companies will react and consumers will react, and we'll see what the Fed does when they get some actual real data.
Thomas, good to see you. Thanks so much, as always, for the insights.
Great. Thanks so much.
Chronic care company Omada Health is set to begin trading Friday under the ticker OMDA after raising $150 million in its IPO. Anjali Kemlani joins me now from the NASDAQ with the Omada Health co-founder and CEO, Sean Duffy. Anjali, take it away.
Thank you so much, Brad. You're right. Right here I have with me Sean Duffy, who is the CEO of Omada Health and a co-founder. Sean, thank you so much for joining us today. And I mean, really exciting day. You're going with an initial public offering of 7.9 million shares at $19 per share. Talk to me about why now. Why is this moment so important? Because you're the second digital health company to go public this year, and all eyes are on you.
Firstly, thank you for having me. Such an exciting day. So congrats to everybody, at Omada. So the why now, really it's a mix of what we see in the business. So what we love is we've expanded from one care area to 4. We love that last 12 months revenue grew 44%, while on the back of only 11% increase in OpEx. And meanwhile, we like what we see in this world of GLP-1s and feeling the customer demand. So that's the business. And then the capital markets have in many ways asked us to come in. And these are not shy investors. If you pause for that 5 minutes at the end and be like, what do you think? Like it, dislike it? Would you be interested? They'll tell you. So we felt pull.
That's really good. And I'm glad you brought up the GLP-1s because I feel like that has been the focus on the company, though you do have other chronic diseases that you cater to. Why is it the moment right now, even though you don't sell GLP-1s and you don't prescribe them, why is it so important to meet the moment now and say go public now versus during that pandemic time where a lot of digital health companies were coming to the market?
Well, I mean, starting backwards, in the pandemic era, we had just expanded to new care areas. And I had sensed that these benefits leaders would really prefer working with one partner across multiple care areas, but we had just started that. And when you're becoming a public company, you want to make sure to have the proof points out there. So we'll hang out, we'll stay private, there's no rush. In retrospect, it's a great decision, that worked out. And then for your comments, I mean, the GLP moment hit. It almost feels like the entire Omada journey leading up to today left us in a place to be able to serve our members on these meds, because an injection's not getting to know you. An injection's not saying, what might a week look like in your eating behaviors, your exercise behaviors, your strength training, your activity, and that's where Omada can come in to operate alongside the med.
So when we're talking about these patients that you care for, you're guiding them through their journey, through their health journey. And part of it is, digital technology and technology that didn't exist when you founded in 2011, right? So you've had to spend a lot keeping up to pace with what the technology is, including AI, I'm assuming as well. But there's also the digital tech and wearable side of it. So CGMs or continuous glucose monitoring devices are part of that story. We see that as used largely by diabetics, but it's become part of sort of the general public sphere. I see on social media folks just wearing CGMs tracking their food. So is that included as part of the journey? If someone has got access to a CGM on their own, can they come to you and be part of the journey there as well?
Yes, so I mean, CGM's critical, especially for Omada's members who have diabetes. And so we have a device arsenal, if you will, scales, blood pressure cuffs, glucometers, and CGMs. And I have a really neat relationship with Abbott and a proprietary relationship with Abbott to ensure that all our members with diabetes start their journey with a CGM, because our care teams love it. The fidelity of the data you get from CGM versus A1C gives them a better path toward helping our members, and our members love it. And so it's a combination of the devices, our compassionate care teams, and the software that ties the room together and gets outcomes. And a CGM has been a critical part of that journey for our people with diabetes.
You mentioned that you were pulled into the market, kicking and screaming against your will, I'm sure. And so I'm curious about what you want the market to do for you, because you're going to start getting all sorts of questions about profitability, about how the company is growing, and the markets and lines and areas. And that's going to be a lot. You're going to be under a microscope like you've never been before. So talk to me about that and what you think the market is looking for from the company.
Well, what's fun is many of the shareholders that are joining today, I mean, we've known each other for years. And I walk into these rooms, it's not like we know each other's kids' names yet necessarily, but they're like, Sean, like incredible progress, phenomenal Q1. You just keep doing what you said you're gonna do. And I think that that's fundamentally what the markets want. And it's germane to our values at Omada, which is cultivate trust. And it's just a neat moment in time where the new shareholders that are coming in can help me and help us imagine a path to not just the millions of members, but the many tens of millions, which ultimately helps us achieve our end mission, which is explicitly to bend the curve of disease.
And really quickly, to final question for you, looking at the trajectory for the company, looking at the focus on the GLP-1, you've set yourself up with other chronic diseases. Do you anticipate that the GLP-1 market is one that will just sort of fold into natural conversation, or is it a standout for you?
It's one where a couple years ago we started to feel just enormous asks for our customers to help them solve their worries about the positives of the med and some of the potential complexities. So it's our view is it's an exciting new chapter. Now that being said, we're really just getting going. I mean, last year in March, we were privileged to work with Express Scripts through EncircleRx for that GLP solution, and now we work with 2 of the 3 major PBMs to support people alongside the GLP-1s with just excellent services and lifestyle change.
So we'll be watching that. Thank
Please
you
do.
so much for joining us.
My
Sean
pleasure.
Duffy, CEO of Omada Health. Brad, back to you.
Anjali, thanks so much. Appreciate you for bringing us that interview. Now time for some of today's trending tickers. We are watching apparel and space stocks. Well, let's make it make sense. Joining me now, we've got market domination co-host Julie Hyman.
You gonna wear your jeans to space?
Well, I'm trying. I'm just starting with,
go.
Summer Fridays, Jeans Fridays. Why not? First up here, let's set the stage for Guess and G3 moving in opposite directions this morning after both reporting results for the latest quarter. Guess moving higher after revenue grew 9% with its acquisition of Rag & Bone, contributing to its overall growth. Meanwhile, shares of G3 sliding after sales fell over 4% in the latest quarter and issuing weaker than expected guidance for the current period. And taking a look at shares of G3 Apparel, they are down right now by about 14.8% right now.
Yeah, let's talk about Guess a little bit first, because there's been an interesting story for this. It's actually down 50% or so over the past year. And yes, it did buy Rag & Bone, but there's also been talk of Guess being an acquisition target on the part of Authentic Brands. That's according to reporting from Bloomberg earlier this year. Also, Guess had got an offer to buy it from WHP Global. So there's been a little bit of bidding for the company that has seen it bounce a little bit since April, but it's still down quite a bit. So the company looking, of course, at the tariff effects potentially and saying that they have taken some measures to manage tariff exposure and protect margins. They said this year's net impact will be less than $10 million based on current conditions, and they've incorporated that into the outlook. The outlook for the year, adjusted earnings per share of $1.32 to $1.64. So that is a lowering of the top end, but still the estimate's $1.46. So still, leaves them some room for upside.
Yeah, increases across some of their key markets here, especially within Europe and the Americas for their revenue increases. 8% in Europe, 9% in the Americas in the retail segment there, and then wholesale revenues also increased 63% in US dollars there. So we'll continue to watch Guess as well going forward here.
Yeah, and then G3, I just wanted to mention what's going on there while we're talking denim. This company seeming to have a different reaction to tariffs. This has been so interesting, hasn't it, this earnings season, when you get one company saying, for example, we're raising prices because of tariffs, another company saying, no, we're not raising prices. In other words, it's been, at least the messaging around how companies are dealing with tariffs has been pretty different, even companies that are in the same business. Yeah. So likewise here, you've got G3 withdrawing its profit forecast for the full year because of uncertainty around tariffs here. The company says it's trying to offset costs here, but it sees additional expenses of $135 million on the unmitigated cost of tariffs. So again, you've got it all depends on where people source from, what their customer base is like, and whether they can raise prices, et cetera.
Yeah, all right. I'm taking a look at some of the products on their site, at least as of right now, to see where I might need to update my closet. We'll see.
I mean, these jeans are nice. I don't know.
These are fine. These are fine. They wash well as well. Space stocks, including Rocket Lab and Virgin Galactic, they're getting a boost after President Trump and Elon Musk, they traded threats, we can call them, I suppose, on social media to terminate contracts between the U.S. government and SpaceX. Indeed, threats there. President Trump threatening to end billions and billions in contracts for SpaceX, while Musk contemplated decommissioning its Dragon spacecraft before walking back those comments. So maybe a macro trade as well. Musk always chickens out. I don't know.
I don't know.
I mean,
it's not trading threats to meet behind the gym after school, although it felt a little bit like that. But no,
Twitter
threats.
Fingers. Yes.
Yeah, Twitter fingers. Everybody's trying to figure out, will this actually have an effect? Is it just a matter of threats? What is the ripple effect going to be on the space industry? I mean, these other companies right now don't necessarily seem to be acting as viable competitors to the likes of SpaceX, but will this give them some kind of leg up? Unclear. One thing I did want to mention that I noted as we see these stocks soaring today is there is very high short interest on both Virgin Galactic and Rocket Lab. Virgin's short interest, according to Bloomberg data, as a percentage of float is almost 30%, which is pretty darn high. Rocket Lab at 14% is also quite high. In other words, what you sometimes see is when a stock gains, you get a short squeeze where the shorts get squeezed out. They have to cover, which can cause more of a gain in the stock. Yeah, government contracts is one of the key areas that Rocket Lab did talk about within its most recent Q1 earnings call, where they were talking about some of the NRO Office of Space Launch, other stakeholders across government, and how key that is, and some of those contracts to their business going forward from here. Julie, thanks for helping us break these down. Yeah. Thanks for having me.
Oh, of course, anytime. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up on the other side here, we've got much more on wealth, including a deep dive into today's jobs report, plus tips for LGBTQ plus job seekers. Stay tuned. The U.S. economy added 139,000 jobs in May, more than expected. Unemployment also remaining steady in the month at 4.2%. Joining me now in studio to break down the report, we've got Andrew McCaskill, good friend of the show, LinkedIn career expert. Andrew, good to have you back here. What do you make of this month's numbers?
Listen, I think what we're seeing is that businesses are hiring. They're still hiring. Unemployment is sitting pretty steadily at about 4.2%. Interestingly, though, healthcare is showing big gains, and ironically, hospitality re-enters the chat. We haven't seen hospitality on the list of industries that are hiring most recently, and I think that that's good news. I mean, that we'll see once hospitality is starting to come back. There's a bunch of other things that could be up for that as well.
Well, it's so interesting, especially reading through the reports over the course of this week, where wages stand within all of this. What is the assessment on where wages are continuing to outpace inflation and what that means for the confidence in employees from what we're sensing at this juncture?
I think what it means for employees is that at every juncture, yes, their hiring is happening, but you're going to have to negotiate for your life, right? That you're going to have to go into whatever interview process with as much information as possible, with as much leverage as possible, really being able to tell your story, making it so easy for people to hire you in a way that we've never seen before. So when it's one thing for us to talk about, hey, the job market is competitive. You've heard me say that many times, but what it means in terms of for job seekers right now is that they're going to have to be so strategic, where geography strategic, industry strategic, maybe even looking at parts of their skill set that they lean into less, but are more valuable and more marketable to help them snag that job.
I also want to talk about a report that LinkedIn recently released. It's Belonging Report and the Belonging Blueprint, finding that only 35% of LGBTQ plus professionals feel comfortable being their full selves at work. What were some of the findings here that really stuck out to you?
So a lot of the findings that stuck out were that LGBTQ plus professionals, they have a higher rate of turnover once they get into organizations, largely because the organization was not what they thought it was. So you may see a job description that looks very inclusive. The company looks really inclusive on paper. What we did with this Belonging Blueprint was saying, it's really important for you to know before you go. So here are the questions that you should ask. Here are the culture cues that will help you identify safer spaces. Many people have felt like they've had to code switch. Going into a safer space, using some of these tools and tactics on the front end, like looking at using the values-based matching filter on LinkedIn, or looking at these company pages to see if they have employee resource groups. Also, phone a friend. Your network will tell you whether or not this is a safer place for someone from your community. Friends won't let their friends go and work at companies that are anti-LGBTQ+. The other piece of it is that the interview process and the offer letter process are also key opportunities for you to jump in and see what that process looks like.
That's a great point.
Yeah.
You have tips, and you were starting to hit on some of these. For every step of the job seeking process, starting with the job search, how can we leverage and the community leverage some of these tools to make sure that they're going into an organization, which you were starting to touch on, that actually is supporting, not just because it's the du jour.
Yeah, not just it's Pride Month, right?
But because it's more in their long-term just value system that they have.
Yeah, on the front end, looking at some of the indexes like the Human Rights Campaign, like trusted sources for members of the LGBTQ plus community to better understand what a company's culture is. The other thing is during the interview process, ask really smart questions. Even if you're not comfortable saying, what's it like for a LGBTQ plus person here? Look and see if are the hiring hiring managers or recruiters using pronouns. Maybe say, hey, I saw you have employee resource groups. Talk to me a little bit about what those look like and how you feel about them. Even just their reactions to you asking about that can give you some real clues. The other thing for LGBTQ plus people that I think is really important too is like, you may not always be able to say, oh, well, are there other queer people in leadership? Because you can't look at people and tell. Is take a look at, are there members of other marginalized groups in leadership? A company that has women and people of color or people who have disabilities in leadership probably also is a company that may have real commitments to inclusion, equitable hiring, and being able to places where people can thrive. The offer letter is a big deal. Yeah. We oftentimes look at the number and we're like, yay, we do the math. It's the offer letter benefits that are so important, because if a company on their offer letter benefits, if the company has benefits for things like family planning or family building support, or you may have only one stop on your gender journey, but if the company has gender affirming care, it's a good sign that they have other policies in place that will be highly inclusive.
I'll add one more. Take a look at the companies that have had shareholder votes where those shareholders have voted down anti-DEI, which this also includes anti-DEI activist pushes where shareholders have actually pushed back against those to make sure that there are more opportunities to uphold these values as well. Yeah. Andrew, thanks so much for taking the time.
Thanks, man.
Appreciate it. Coming up, everyone, we get a read on the state of the consumer with the CEO of Rent the Runway. That is next on Wealth. Let's get a brief check of the markets 2 hours into the trading session on this Friday. Taking a look at the Dow Jones Industrial Average right now. We are higher by about 0.9% year to date, barely holding on to gains by 0.3%. Let's put this on an intraday chart. We've been higher largely throughout the day. Actually, yes, throughout the session here. I had to remove some glare from my angle here looking at the Wi-Fi Interactive, but we have been solidly in positive territory on this here day where we got that fresh May jobs report data that the markets are reacting positively to here. The NASDAQ is higher more than 1%. S&P 500, that's up, and we'll round that off to 1%. Let's take a look at some heat maps just very briefly. Taking a look at the sector activity here. We'll put this on an intraday look, and we were higher across the board for the 11 S&P 500 sectors. Utilities deciding to throw a little tantrum here right now. It has been waffling, hyper oscillating in and out of gains and losses. As of right now, you're seeing it in the loss category here. But energy, that is leading the pack. XLE, that's your S&P 500 energy sector. And also let's take a look at the NASDAQ 100 here. You've got a few spots of red peppered into the crowd as we're taking a look at the biggest gainers here on the day. Marvel, and then Tesla trying to mount a little bit of a bounce back from that $150 billion plus market cap loss yesterday. And so just taking a look at the chart here on the day, you are seeing it over the past 2 days, 2 trailing sessions here, still net lower, but we'll continue to keep close tabs on that. Lululemon, though, that is taking it on the chin right now. The brand of the stretchy fabrics right now, it is moving lower by about 20%. Shares of Rent the Runway are soaring Friday. The online clothing subscription service saw active subscribers hit an all-time high in its most recent quarter. The recovery is notable after a sharp drop earlier this year as companies' efforts to boost customer retention appear to be paying off here. Here to discuss further, we've got Jennifer Hyman, who is the Rent the Runway co-founder and CEO. Jennifer, great to have you here in studio with us. Just take us into your own analysis of this quarter. What really contributed to this performance?
Yeah, so loyalty is the highest it's been in 4 years. Record amount of active subs and record amount of sequential growth in subs. And I think it's because the corporate transformation that we put into place is really working for us. Mm-hmm.
And so when you talk about that corporate transformation, where are we at in kind of like the you are here of that timeline?
Well, first part of the corporate transformation was last year really proving that we could be a free cash flow break-even business. And we proved that the unit economics of this business work, it makes sense financially. And then 2025 is all about growth. And so there were 3 prongs of that strategy. One is around inventory. We're doubling the amount of new inventory on the platform. Customers are seeing that and they're more loyal because people come to us to have variety in their wardrobes. Second was really about product innovation leading to enhanced customer experience. We've launched tremendous amounts of innovation to the user experience over the past quarter, and that's really proof point that the ways that we've simplified our organizational structure and processes have led to like way more agility and ability to kind of iterate fast on behalf of the customer. And then we've gotten much more authentic as it relates to our customers, and as a result of that, our engagement with marketing, so engagement on social channels, is up 163% just in the past quarter.
Let's talk a little bit more about that customer. As a person who has seen my fair share of Rent the Runway bags, those navy blue bags make their way in the deliveries into the apartment here. Who is that core subscriber, and who are you planning to expand the reach to from here?
So I think that we think about the subscriber right now in terms of her aesthetic, and our customer is wanting to be polished, she wants to look sophisticated, playful, she certainly wants to look feminine. And what's interesting about rental now is for the first decade of this business, we had to prove to the consumer and to the brands that like rental was going to be a part of how she got dressed. Now it's a mainstream behavior, and there are many players in the space, and Rent the Runway has the privilege and the freedom to actually compete on aesthetic and to actually compete by nature of the brands that we put onto our platform. So the fact that we're doubling our new inventory this year, we're adding 90 new brands into the portfolio throughout the year, that gives more customers an opportunity to come to the platform, to fall in love with our inventory, and it visually differentiates ourselves from our competitors.
How are you differentiating from those competitors, Nuuly, Fashion Pass, Armoire, who are out there in the market as well, trying to woo that same customer and client base?
Well, the first part is through the inventory. So Rent the Runway is a much more premium set of brands that represent just higher end luxury brands. The second way, though, is through the luxury of the customer experience. So our customer, we have a lot of moms on the platform. We have a lot of professional women who do not have time. So therefore, we've launched services like a concierge, styling service, at-home pickup, Notify Me, back in stock notifications that help our customers save time. Because when you're in your 30s and your 40s and you're managing your family, your career, et cetera, like that's the number one luxury that we can give to you.
Absolutely. And so as you think about the pricing model around all of this, because we continue to read through some of the consumer confidence reports and really trying to figure out where consumers are stretching their dollar as much as they possibly can right now. We know the lowest price, or one of the offers, is roughly $100 a month. Are you seeing customers favor the less expensive tier in this uncertain macro environment that we're in right now?
We're actually not. So we've seen higher growth in our higher price tiers. Of course, we have an a la carte business that does not require a subscription, where you can come in, rent a dress for an event starting at just $30, and you get that in 2 sizes. But what I think is really interesting is that rental is a value play, especially clothing subscription. You're getting thousands of dollars of clothes per month. You're getting it for anywhere between $100 and $150 a month. And as clothing becomes more expensive elsewhere and prices go up because of tariff-related pressure, this just creates even more of a value equation. I think it's incredible tailwinds for the rental and resale industries overall.
And that kind of touches on something that I was wondering as well with regard to the consumer psyche. We hear more and more about, hey, this could have a tariff type of pricing that's added onto it at the end of the day that might hit your pocket or your pocketbook. As you're thinking about and monitoring those engagements with consumers, how since and kind of post tariffs have you seen the consumer psychology change, if at all, among those who are engaging with Rent the Runway?
Listen, I think it's not just about tariffs. I think that luxury has fundamentally priced itself out of the market over the post-COVID period of time, and the consumer overall, regardless of her income, is just smarter about how she's spending her money and where she's allocating her money, which creates tremendous opportunity and tailwinds for rental. We're really well situated in this space because we're unlike a traditional retailer in how we acquire inventory. The majority of our inventory is on revenue share with our partners, where we don't pay for it up front, we pay on performance. The reason for that is that brands actually view Rent the Runway as a powerful marketing channel to help them acquire new customers, and they see their CACs on Rent the Runway be lower than CACs that they would find on, media channels.
When we were in the break, you said men's is creating a little bit more of an attractive entry point at this juncture than years past.
I think that rental is just mainstream now.
Yeah.
So the goal is to grow, be aggressive, and take advantage of the market that we invented.
Great to have you here in studio with us, Jennifer. Appreciate the time.
Thank you so much.
Absolutely. Coming up, in the age of online shopping, are teens still going to malls? We get the inside scoop from the CEO of Tanger Outlets. That's next on Wealth. Are malls back in fashion? Despite the macro headwinds that are weighing on consumer sentiment, foot traffic in malls increased across all formats, with indoor malls up 6.7%, open air shopping centers up 5%, and outlet malls up 3.9%. That's according to data from Placer.ai. So, what's bringing all of these shoppers to the mall? Joining us now to answer that very question, we've got a good friend of the show, Stephen Yalof, who is the CEO of Tanger Outlets. Great to have you here back on Yahoo Finance. Just take us into the foot traffic that we are seeing right now, even as we try to wrap our minds around what the consumer, us, what we are navigating through on a consumer confidence side, and as well as the discretionary dollars that are out there to actually put to work.
Sure. I think shopping's entertainment. Let's stop with that. And with all this uncertainty in the marketplace, it's also, you've heard retail therapy.
Yes.
So I think you've got a lot of folks who want to, get away. They want to do something exciting. They want to do something entertaining. And they're showing up at shopping centers for that reason. And the shopping centers are doing their job to make sure that that entertainment is there when they get there. Better restaurants, right? Better movie theaters, and restaurants and movie theaters and bars and movie theaters. So the whole business is evolving to bring the customer in and keep them there a little bit longer.
When you talk about the footprint that Tanger Outlets has and has had for years, what does the expansion of that look like at this juncture, knowing that land comes at a premium right now, and then additionally you have to make sure that you're selling out all of these lots as well?
Sure. Well, first of all, it's a lot less expensive today to acquire than it is to build. In fact, it's probably 50% cheaper. So we're buying shopping centers at 50 cents on the replacement dollar. And the last few centers that we bought, which were in great markets, A centers in what might be considered mid-tier markets, but there are markets that the best brands want to be, and these are full-price shopping centers, which is new to the Tanger platform, but definitely something that we've been working on, post-COVID for the last 5 years. We've been adding more experiential, we've been adding more full price, we've been adding more restaurant into the outlet platform, and that's really set us up to execute in this full-price space.
Does that mean my next gym membership is going to be annexed to a Tanger Outlets facility?
Well, if you live in Savannah, Georgia, it sure will, because we're under construction with Planet Fitness in our shopping center right now.
Well, I fly into Savannah when I go to Hilton Head, so you got me there. As we think about the Gen Z consumer as well right now, Gen Z and younger, as we're thinking through how much of this and the shopping experience is also what you were mentioning, experiential, it's entertainment, it's a social construct, it's part of that too. What are you seeing among that younger cohort of shoppers?
Yeah, it's starting with the Gen Alpha. I mean, the 5-year-olds and older who have now discovered stores like Ulta and Sephora as the place they want to go to. I guess when we were kids, we wanted to go to the toy store.
Yeah.
These kids are a little bit more sophisticated now, and they're engaged in those products. Those companies are marketing to that younger demographic, and so we think it's really important as the operator of a shopping center that if we're going to speak to a younger consumer, we're going to advertise for a younger consumer, that we have to have the products that they want when they get there.
As you think through the promotional landscape, and this is maybe a broader inventory question, because we know that what we've seen in earnings is that retailers and manufacturers, they had to make sure that their inventory was beating some of the tariff deadlines. Right. They took delivery earlier on. Did that mean an influx of trucks that were showing up to Tanger Outlets just to make sure that they could place inventory and maybe just get it from warehouses or get it to warehouses from warehouses to the facilities that they're trying to sell through at? And what does that kind of look like from the larger scale from what you've seen?
Well, it's interesting because we've spent a lot of time walking our shopping centers. That's what we do. And one of the first things I look at when I'm looking at a center, I walk every store, and I'm looking at inventory levels, because most of the contracts that we have with the retailers give us the opportunity to get some upside if they're really successful.
Interesting.
Which makes us their partner. So when I'm their partner, I want to make sure that they have inventory, because a good friend of mine at Ralph Lauren who once shared with me the fact that you can't sell what you don't have.
Yeah.
So there needs to be inventory in the stores to satisfy the customer. We want to make sure that customer has a great shopping experience. A lot of inventory also leads to that. We see there's a tremendous amount of inventory in the stores right now, but there's also that uncertainty that maybe the shelves might be a little bit more bare in the second half of the year. So one of the big holiday shopping, I guess the biggest shopping holiday of the summer is back to school,
right?
Which typically takes place in August. So we as a company, we're pulling back to school forward. Yeah. Reason being, if there is a concern in the customer's mind that there might be thinner shelves, higher prices, or you just can't get the item that you want, we're trying to encourage our customers to shop early for back to school so they make sure that they tick all those boxes and get the items that they're looking for.
Are a lot of your partners anticipating that there will be deals on and that remediate some of the largest tariff concerns by the deadline of early July?
It's all across the board. 2 weeks ago we were at ICSC, which is the big shopping center convention. I had the opportunity to sit down with 50 or 60 of our closest retail partners, and that's typically the first question that you ask. What we're learning is the retailers that are the most agile with their supply chain are the ones that are far more confident in their ability to navigate the tariff situation. But again, they're doing, as you said, bringing inventory in a little bit earlier. Look, as far as we're concerned, the more inventory that the retailers have, the more they bring in early. If the tariff back half of the year, we see a tsunami, then my guess is we'll probably see a little bit more expensive inventory. Price products in the back half. But if it's just a casual wave, then there's going to be a lot of excess inventory in the channel, much like we saw in 22 post-COVID when the supply chain logjam broke and all that product came back to the States. And that was a great benefit to our platform because we see a lot of that inventory that comes in clearance and we turn that into cash for our retailers.
Always stylish. It's in your work history DNA. Stephen, thanks so much for taking the time as always.
Thanks for having me.
Good to see you. Coming up, how to adjust your finances if you got married, divorced, had a child, or hey, maybe you retired. Good for you. That's on the other side. All week long, we've been conducting your mid-year financial checkup. And to close out the week, we want to take a look at how life changes like marriage or having a child or retirement can change your finances and your taxes. I want to bring in Andy Phillips, H&R Block Vice President of the Tax Institute. Andy, good to have you back with us. Why is it important to keep track of major life changes for your finances?
Hey, absolutely. So look, with life changes, your tax situation changes as well. So you need to take that into account. The two most common ways people do that throughout the year is either through their tax withholding because they're an employee or through their estimated payments if they're self-employed. A lot of times people don't think about this when they have a life change. Simple things like maybe you get a second job. Well, your withholdings with your employer are only thinking about that they don't know that you have other sources of income. And if you think about how our taxes work, there are graduated tax rates, meaning as your income goes up, that higher income is going to be taxed at a higher rate. And so your withholdings, your employer who's withholding, if they don't know there's other sources of income, they're going to withhold at a lower rate, which means when you come to the end of the year, you may actually be under withheld, which means you may owe a balance due or have less refund than you're expecting.
And so how does changing jobs and insurance affect your finances?
Absolutely. So when it comes to changing jobs, you've got to look at, okay, one, you are going to have to create a new W-4, but maybe it's a situation where you got a pay raise. So there's the tax side. I need to look at my whole tax situation. If you're married, look at your spouse's withholdings and say, hey, are we withholding at the right rate? Also a good time to just make sure you're not kind of missing out on some of the other common mistakes people make. Sometimes if you have children that qualify for the child tax credit, both spouses mark that on their withholding, saying, yeah, I think I'm going to get this credit. Well, you only get one on the tax return. What that means is both spouses are having their taxes withheld at a lower rate. And so it has an outcome at the end of the year. This sometimes disappoints people. Aside from taxes at the financial side, maybe you've got a raise. A lot of times when people make that change, they kind of have a lifestyle creep. You get a 10% raise. So you just kind of naturally start to spend more money without thinking about, hey, maybe I should reset my budget and think about what are the tools I need to say, okay, maybe I should start to increase my retirement contributions. Maybe I should look at how much that raise was. And if possible, automatically scoop some of each of my paycheck into a savings account that's earning a nice yield for you, and it's not there for you to spend in your day-to-day checking account.
Yeah.
Really simple things people can do to be better with money.
What about if you get married?
Absolutely. So getting married is another big life change. Of course, it's going to have those tax changes. A great time for a mid-year checkup. So look, at H&R Block, what we do is we offer our clients a complimentary mid-year checkup, which we can offer throughout the year, and a big life change is an opportunity to do it. Sometimes you just get married. It can be awkward to talk about finances, but both taxes and a financial plan, figure out who's covering what. Are we going to have joint accounts? Things like that are better handled on the front end. They can avoid friction at the end of the year when you say, oh man, we should have planned that better. Why didn't you talk to me about that? So again, it's a big life change. It's going to have tax changes. And so people need to take steps to address it. And if you're not sure how to do that, great opportunity to find help.
Just lastly, while we have you, 30 seconds, what about retirement here? We promised folks an answer on this one.
Hey, retirement. A lot of times you get that final paycheck from working and you've got to reset and say, okay, now I'm not bringing in the same amount of income. What does that mean? What money are you going to live off of? You've got to make the decision of when should I take Social Security payments? Should I start receiving Social Security right when I'm eligible? Or can I defer it several years, which is going to lock me into a higher payment? You've got to determine, hey, what is my financial need? What is my health? Things like that to figure out what's best for you, but really important to be intentional there. Likewise, with your retirement plan, you don't immediately, just because you've retired, have to start taking distributions. Even if you're old enough where you're not going to be subject to any penalties for doing that, the longer you wait, the more you can compound that interest and save that for later in life.
Yeah.
So really important to try to time that out and work with a professional to start taking those at the right time. You are going to hit an age, it varies by year, but you're going to hit an age where you do have to start taking a portion of it out though.
Andy, thanks so much. Appreciate it.
Thanks for having me.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned for Market Domination, 3 p.m.